we are kind of getting caught in a trap here where we're required to comply with regulations, but the regulator itself is making it nearly impossible to comply.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin, author of The Cryptopians. I started covering crypto 9 years ago, and as a senior editor at Forbes, was the first mainstream media reporter to cover cryptocurrency full-time. This is the September 6th, 2024 episode of Unchained. Where can you find $700 million in real-world assets, 11 million daily operations with industry-low fees, powered by 450,000 plus on and off ramps across 180 countries? The Stellar Network. Today's episode is brought to you by Gemini, a US-based crypto exchange built for new and advanced traders. Gemini is offering new customers $15 in BTC when they trade. Sign up today to earn your Bitcoin. Mantle's METH is now the fourth largest LST with $1.3 billion in TVL. METH offers holders cumulative incentives and airdrops, in addition to native ETH POS yields. This includes exclusive rewards like Eigen and Cook. Check it out at meth.mantle.xyz/campaigns. With iTrust Capital, you can buy and sell crypto in a tax-advantaged retirement account. Enjoy significant tax advantages, 24/7 access, and the industry's lowest fees. Polkadot is the original and leading Layer 0 blockchain with over 2,000 plus developers. And the Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem. Join the community at polkadot.network/ecosystem/community. Today's guest is Larry Florio, General Counsel at 1KX, a crypto-focused investment firm. Welcome, Larry.
Hey, Laura. Thanks for having me.
This week, we got news of an interesting enforcement action by the SEC against Galois Capital, a trading firm that went under because a significant portion of its funds were on FTX. What was this enforcement action about?
So there were a few different parts to this, some maybe more surprising than others. I think one of the primary things that was happening here was the SEC claims that they were holding tokens, and this is the specific language out of the settlement, tokens that were offered and sold as securities. So there's a little bit of a change from what we've heard from the SEC before. But as part of that, the SEC claimed that Galois Capital was holding these tokens that were quote unquote securities, not with qualified custodians, which is a requirement for all registered investment advisors.
And what was the previous language?
So very often they would say that crypto asset securities and sort of leave it there, rather than here they've sort of added more nuance to it than they typically do, saying that tokens were offered and sold as securities. So tokens maybe are not per se securities, but were being quote unquote offered and sold as them.
Okay. Yeah, it's almost like they're incorporating some of the criticism from, for instance, like, am I right that it would be like the Ripple ruling, or what would be?
Yeah, that's right. It's a little difficult to even really pinpoint what the SEC's internal theory is on this, since from case to case, when they actually go to trial, they've sort of changed and adjusted the theory, and it changes a bit depending on what court they're in. So they've gone with the tokens are securities. They've tried this. They were offered and sold as securities before. It's a little bit all over the map, although this seems like they're focusing more recently on this offered and sold as securities. Presumably, they think that's a better winning argument for them when things go to trial.
Okay, but they don't actually name the tokens, is that correct?
That's right. They just sort of keep this, they add this sort of just hand wavy, oh, there were tokens and some were offered and sold as securities. So they're almost acknowledging that not everything in Galois' portfolio was actually a security, but that some were. We don't know which, we don't know why, we don't know how.
And how typical is that for there to be an enforcement action without the actual assets involved being named?
Within crypto, it's a little bit of a mixed bag there as well. I'd say that more frequently than not, at least as of over the last couple of years, they've named at least a couple of the tokens that they think are securities. So they'll give a few examples. They're pretty consistent with which ones they name, but here they don't bother at all. And they have done that, I believe, at least once or twice in the past. But it's frustrating here, especially because they're adding a new implication, a new layer to the attack on crypto, where they are saying now, okay, you're now violating your custodial regulations and requirements as an asset manager.
Yeah, so this to me seems to be the biggest kind of upshot from this enforcement action. So just explain what a qualified custodian is and what the violation was.
Sure. So qualified custodian, there's a few different things that can qualify as it. The primary ones that people think about are banks, broker dealers, trust companies, things that institutions that you would normally consider safe places to hold your money, hold your assets. There's also a bit of a catch-all for foreign institutions if they are the type of institution that would customarily hold customer assets segregated from proprietary assets. So as long as they're in a segregated account separate from the company money, they're usually considered okay, as long as, again, like foreign banks, foreign brokerages are typically what's considered to fall into that category. But it's vague almost intentionally, because they're not trying to regulate, at least in this instance, the rest of the world and how they handle their financial systems.
But just to understand, so in this case where Galois was using Fireblocks, which then was using FTX as a trading venue, would that requirement apply to FTX itself? Because FTX claimed that it was segregating accounts in that way. So if it does apply to FTX, then it's sort of like they're punishing Galois for not knowing that FTX was committing a fraud, which seems strange.
Yeah, it's definitely strange. I mean, they do actually call out in the settlement order that FTX Trading Limited, which was the entity of part of the FTX organization in question here, was not a qualified custodian. So they use that as an example. They don't actually name Fireblocks at all in this, although Galois did in their thread on Twitter following the release of the settlement, but they don't actually name Fireblocks itself. They do focus on FTX, which is a little surprising because obviously we know what happened now, but FTX was a regulated entity in the Bahamas at the time. And on paper, it does seem like it would be the type of institution that would fall into that foreign institution category within the qualified custodian definition. So it's definitely a little concerning.
And one other issue is I saw that Galois said that they had submitted to the SEC that they were using Fireblocks. So there was knowledge there of the setup prior. I don't know if that matters. Like, is that something that the SEC would or should have flagged at that time that it was filed?
I would think so. I mean, so the filing where they listed that is what's called a Form ADV. It's a publicly available filing that all registered investment advisors have to submit to the SEC. Anyone can go online and look those up for any registered investment advisor. And in that filing, you always have to list which custodians you're using for fund assets. So it's very common. You typically see, the large, well-known banks are very common on their brokerages. Fireblocks itself is actually not, it's not surprising to me that they are included there. There's lots of crypto asset managers that do use Fireblocks, and they typically do disclose it on there because within our industry, there's different risks or different concerns. So qualified custodians aren't always actually the safest place to hold crypto assets, digital assets. But Fireblocks provides a lot of similar sorts of protections, more focused on the risks of crypto. And so they're really commonly used. They are very frequently disclosed there. So it's a little surprising to me, yes, that they didn't mention Fireblocks and that it seemingly never came up, you would think, during this process. Now, these settlement orders are pretty heavily negotiated. The language goes back and forth between the two parties a lot. But I'm a little surprised that the SEC didn't want to name Fireblocks in there also. There could be reasons for that, but I was a little shocked to see that, or rather not see that.
Okay. Yeah. Well, there was, I would say, a fair amount of outrage about this enforcement action on Twitter. And obviously, with the SEC, with any enforcement action that they pursue on crypto, there is generally some outrage. But I saw a lot of people talking about kind of like inherent contradictions in what the SEC had done here. For instance, Jacob Franick of Alliance DAO tweeted, "Let's review how egregious this is. The SEC requires RIAs to custody with qualified custodians, but says there are none, and it blocks new entrants from becoming qualified custodians, and thus it can penalize any crypto RIA whenever it wants." Do you agree with his assessment of that? Is that what's actually happening?
I do, actually. It's a really frustrating state of affairs where Everyone's trying to do their best. I mean, there's very few asset managers out there in general, crypto or otherwise, that are trying to avoid these regulations. And the SEC really does come out and effectively say there are no qualified custodians for crypto. And they're taking a lot of steps to try to even reduce the number that we may have out there. So there is that proposal, it may be in effect soon, SAB 121. And that was an accounting standard that was really preventing public companies from custodying crypto exactly for these sorts of situations. So we are kind of getting caught in a trap here where we're required to comply with regulations, but the regulator itself is making it nearly impossible to comply.
Well, okay. And just to clarify, I saw some people saying that Coinbase and Anchorage are qualified custodians. Is that the case? Or like who in crypto are qualified custodians?
It probably depends on who you ask. Coinbase and Anchorage certainly would say that they are qualified custodians, and there's entities in their structure that are licensed trust companies, like licensed broker dealers. They have those entities, and those do fall within the definition of qualified custodian. It's maybe a little bit more of an open question as to which entity in their structure is specifically holding those assets. I'm sure that they've spent a lot of time internally at these places thinking about that and are comfortable that they are indeed qualified custodians. The SEC hasn't come out and actually said one way or another whether they are, to my knowledge. And while it's sort of unusual to need a sanity check from a regulator, this is also the situation where we're in, where, especially in Coinbase's case, I think a lot of your audience knows, they're in the middle of pretty heavy litigation with the SEC right now on a few different fronts. One of those being the SEC claiming that they're acting as a broker without being licensed as a broker-dealer. So it seems like there is just a disagreement on what Coinbase even is.
And because of this kind of catch-22 about, whether or not any of these entities are qualified custodians, and in particular, frankly, just because of the types of tokens it is that these different crypto funds like to trade, and what it is actually available at Coinbase and Anchorage, even if they do end up qualifying. Does this kind of effectively amount to a ban on crypto funds?
It kind of does in a lot of ways, unfortunately. Now, there's a little bit of a nuance to this in that not all assets that an asset manager holds have to be with a qualified custodian. It's only securities specifically. And that's how the SEC is getting us in this case here, where they're not even telling us what tokens are securities. Some are securities. Those have to be held with qualified custodians. And they are really saying, I think you're right, Laura, that, well, you need to comply with these rules, but you can't comply with these rules in this asset class. So really, if you are trying to be a regulated entity in the United States, you cannot touch and trade in these assets.
Wow. Okay. And then just to put a finer point on this, what would be the optimal way, or what is like a more typical way for the SEC to handle this kind of thing?
What would be very useful in this action that we don't have is how and why whether it be Fireblocks or FTX or otherwise, how and why these were not qualified custodians. We don't even get that level of detail in here, and it would really only have cost the SEC maybe one more paragraph in a pretty short order to begin with to give us that sort of insight and that information. So here we are, once again, being regulated via enforcement, and that regulation isn't even telling us what the regulation is.
All right. So in a moment, we're going to talk about a few other small matters regarding this particular enforcement action, and then also discuss the CFTC's enforcement action against Uniswap. But first, a quick word from the sponsors who make this show possible. The Stellar Network is built to power real-world solutions that will onboard the next billion people. Build a future-proof dApp underpinned by more secure Rust smart contracts, transactions confirmed in seconds, and a predictable fee structure that scales. Find product market fit with one of the fastest growing DeFi ecosystems and a user base of millions in emerging markets worldwide. Deliver real-world utility on a network with more than 16 billion network operations. Build better, build on Stellar. Head to stellar.org to learn more. Gemini is a crypto exchange with tools for all traders. Cameron and Tyler Winklevoss founded Gemini in 2014 and have been pioneers for the crypto industry for over a decade. Gemini operates with a security-first mentality, From being a licensed full reserve exchange and custodian to offering leading security features like passkeys, Gemini continues to set the bar for compliance and innovation. Head over to gemini.com/unchained and start trading to earn $15 in Bitcoin. Mantle LSP is a permissionless and non-custodial Ether liquid staking protocol deployed on Ethereum and governed by Mantle. METH serves as the value accumulating receipt token of Mantle LSP and is now the fourth largest ETH LST with $1.3 billion in TVL. In addition to native ETH POS staking yields, METH holders can access various yield opportunities across dApps on Mantle Network L2 integrations and more. METH holders have previously received over 1 million in Eigen token airdrops. With the upcoming October 2024 launch of Cook, the new governance token of Mantle LSP, METH holders can start accruing powder rewards under Season 1, Metamorphosis, which will be convertible to Cook. Visit meth.mantle.xyz/campaigns to learn more. Back to my conversation with Larry. Another smaller matter to discuss before we close out this Galois enforcement is they also dinged Galois for allowing some investors to withdraw faster than the stated 30-day redemption period. Can you just talk a little bit about what the significance is of that?
Sure. Yeah, they do talk about this a bit in the action. I find it a little less surprising than their issues with their custodial practices, putting aside whether or not I think those are appropriate. But for a long time, the SEC has had a problem with preferential treatment of some investors over others. This goes back to even before Gary Gensler was chair of the SEC. Now, they take issue with it, and they brought it up at exams many times over at least the last 10 years or so. But the general rule for a fund is that the fund documents control how the fund can operate. And basically every fund document for every fund I've worked with has something in there that the manager of the fund, the general partner, can waive requirements when they want to, whether it be a 30-day notice requirement or something else. So it's always left to GP discretion whether they can flex on these things or not. I think where it became more problematic in this case is that it wasn't just some third parties, and it truly does seem to Galois' credit here that if someone asked for a waiver, they gave it, and they did have they said an internal policy that as long as you gave us at least 5 days notice, we'll do our best to redeem you on your request. The issue that I think the SEC really had here was that there were affiliates of Galois that were taking advantage of this also. So you've got people who worked with the firm that were getting, in the SEC's eyes, better liquidity terms than outside investors. At least outside investors didn't ask for an exception. So if they just accepted that what it says in the docs is what the actual rule is, then they would never know that they could actually have an extra 25 days to make a request and the firm would honor it. I think it's nothing is stated in here, so this is a little bit of speculation on my part, but I assume that the SEC's issue and why they raised it to enforcement on the liquidity terms point has to do with timing around everything that happened at FTX. But it doesn't say that very clearly in here. So again, that's just speculation. And it's really going to be impossible for us to know unless either the SEC or Galois comes out and gives us more detail.
Oh, and you're talking about specifically investors who wanted to withdraw ahead of FTX's collapse.
That's right.
Okay. So one other thing is, amidst all this, SEC Commissioner Mark Uyeda at Korea Blockchain Week said that he actually wants the SEC to define this term crypto asset securities. I don't know if you have any thoughts on his remarks there.
I would love that. I mean, I think we're all screaming into the void a little bit that we would just love to have some clarity from the SEC on what these rules are and how they work. I mean, Chair Gensler very often says the rules are clear, but in this action, all we get is this hand wavy, oh, there were some tokens and some were part of a security or maybe not. We don't even really know what's going on there. And they don't tell us even what the tokens that they think are securities are. So we're left just blindly guessing. And that's just a difficult place to operate. It's once again, I think, just a sign that the SEC doesn't want people investing in this space.
Yeah. And frankly, also, even the fact that the fine was $225,000, there's something about that just made it feel like it wasn't super egregious. And so it calls into question of why they spent the resources. In a similar vein, we saw that CFTC this week also issued an enforcement action against Uniswap for what Uniswap's chief legal officer described as, quote, a fraction of a % of trading. So can you tell us what that enforcement action was about?
Sure. In that enforcement action, the CFTC has alleged that Uniswap Labs, which operates the Uniswap front end, the one that most of us are familiar with, was offering levered transactions to people that are not supposed to have access to those sorts of transactions outside of a regulated forum like a futures market. So they're saying that here, which is really surprising because first off, the Uniswap front end is separate from the Uniswap protocol. And the Uniswap protocol is itself open and permissionless. Anyone can launch a token, create a liquidity pool, and Uniswap itself has no control over that. And in this case, it's even stranger because the leverage they're talking about was embedded within the token. I think it's a little debatable whether or not it was actually, in fact, leverage itself. There were 2 dissents against this order, and Commissioner Pham actually raised this point specifically that the names of the tokens don't have levered. We don't get into any nuances around where the leverage is or how it relates to Uniswap. So this is just a very vague, really unfair action. And I think, again, we're seeing here, it was only a $175,000 fine. I think really it's sort of the connecting thread between the two things we're talking about today, Laura, is that here are 2 firms that are being offered pretty low ball number fines in the grand scheme of how we see these fines come out a lot of the time. So of course they're taking them. Lawyers are expensive. Fighting the SEC is expensive. The fines themselves can be easily within $1 million or billions of dollars. So when someone's offering you not a get out of jail free card, but certainly like a discount against the expected cost here, you're going to take it. And I think in both cases, we're going to see the CFTC and the SEC use these as precedent that they're going to cite in future enforcement actions, in future speeches. And it's really unfair. I don't blame Uniswap. I don't blame Galois at all for taking these. But I also do expect we're going to see these used against the industry in larger actions going forward.
Yeah. And, you mentioned Commissioner Pham's dissent. And she had this very pointed sentence, which was, quote, I am puzzled how we can charge the respondent based upon no evidence beyond the word leveraged appearing in the names of those tokens, which I thought was kind of funny, actually.
Yeah.
So
also, Uniswap wasn't offering anything here, right? They're being fined for a token it was unaffiliated with them at all, and actually wasn't even available through their interface when in a different CFTC enforcement sweep, this question came up. So they do give them credit for cooperating in the order, but it's just so strange to me that Uniswap Labs is being fined at all for quote unquote offering leverage when it's 2 or 3 degrees away that the leverage, if it exists, is even implicitly connected to them.
Yeah, which goes back to your theory of potentially using this just as something to set precedent, which can be used later. I did want to ask a little bit more about Commissioner Summer Mersinger's dissent, because, as you just noted, Uniswap was very not only cooperative, but as she cited in her dissent, she said that they, quote, took proactive measures attempting to block trading of leveraged tokens. And then she says, in fact, Uniswap blocked the particular tokens at issue in the settlement after the commission's settlement in a previous DeFi sweep involving those same tokens. She goes on to say, rather than applauding Uniswap for being attentive to our enforcement efforts and initiating steps to respond to our approach in policing the DeFi space, we brought charges against Uniswap covering the period before those particular tokens were blocked from its platform. So, yeah, can you just talk a little bit about what she's talking about there?
Yeah, she raises a lot of great points in her dissent also. This is definitely one of the major ones. It's really just unfair. I mean, no one's getting real credit for being a good faith actor in this space. Well, I think we in crypto are often saying that we all want to comply with the rules. We just don't know what the rules are. Even here, where presumably we knew what the rules were, that Uniswap knew, and they complied, and they took proactive steps, it's just not good enough. It's like, how does anyone win in a space that's constantly changing and evolving with technology that's not clearly covered by existing rules, when no matter what you do and how good of a citizen you're trying to be, you're going to get punished for it?
Yeah, and she says through this settlement, the commission appears to be taking the position that any DeFi platform could be liable for any and all conduct occurring on its protocol. The practical effect of this approach is to severely chill the launching of any DeFi protocol within the United States. So, yeah, very pointed remarks again. At the same time, we saw that the New York Attorney General, Letitia James, is also issuing subpoenas to venture capitalists about Uniswap. I don't know if you have any inkling what those could be about, or just generally if you have any comments on what that means about the direction of regulation on DeFi.
I think we're once again entering, at least for the moment, of adversarial phase. It seemed like we had a lull there for a little while, especially as the SEC in particular was getting some losses in court. But there does seem to be a new push right now to attack the industry on multiple different fronts. Attorney General James has gone down this road before. It's hard to say exactly what she's looking for here. It could be a fishing expedition. There could be a specific thing in mind that she's trying to get at, but it's not surprising to me, unfortunately, that there's the timing of that right on the back of this settlement.
All right. Why don't we just bring it back to also there's two other things that have been going on in the background that are related. The first would simply be that the SEC has a Wells notice to Uniswap. So I don't know how you think anything that's going on, this way or that happened this week could affect that, if at all.
Sorry, with Uniswap?
With the Uniswap Wells notice, yeah. So I understand it's the SEC.
Yes,
I don't know if either the CFTC action or the New York Attorney General subpoenas could affect that.
Sure. Yeah, I think that and they certainly might. A lot of times there's coordination in the background between different agencies at the state and federal level. There's not always. My, again, speculation here is that the SEC is going to be a little parallel to the CFTC action here. Again, just a front end, wasn't involved with the token itself, but was offering these quote unquote like illegal derivatives to people that aren't supposed to have access. I would expect the SEC is going to take a similar tack, but say that, they were offering tokens that were offered and sold as securities, tokens that are securities through the front end. So they're acting as an unlicensed broker dealer.
And the last thing I want to wrap up with is about OpenSea's tussle with the SEC, which that came about last week. I don't know if you just want to tie up kind of what you're seeing overall, considering that there, was also this Wells notice that OpenSea received.
Sure. Yeah, it's really frustrating. I mean, we don't have all the details there yet. The Wells notice is the beginning of the enforcement process, not the end. So again, just wild speculation across the board from everyone on Twitter about what's happening there. But I'm sure it has to do with claims that some NFTs are securities and OpenSea is acting as also an unlicensed broker dealer, which is a strange action to bring, I think, especially at this time. I mean, OpenSea's business model has been pretty consistent for years, and it's been a very well-known platform for at least as long as that. So to bring an action now, not say like in 2020, 2021, I think raises some questions about what's really happening here. Like what investors need protecting now that didn't need protecting 3 years ago when really all the NFT trading volume was on OpenSea. And even separate from that, the SEC did go after Stoner Cats, alleging that their NFT project was involving securities. I would have expected something with OpenSea to have been made public around that same time, since it just seemed like there'd be some at least thematic consistency there. But now here we are, like another year later, and it's just such a strange action, I think, to be pursuing. Again, we're at the Wells notice phase. So this has still got at least weeks or months ahead before there's any resolution to it, whether that's made public or not. So it's just very surprising to me that they're bringing this action now. Maybe not in light of everything we've seen this week, but at the time, I was a little surprised that they were doing it then.
Yeah, I saw Jake Chervinsky mention that because the fiscal years of these agencies end in September, that may be why we're seeing a flurry of these enforcement actions.
I think so.
All right. Well, Larry, thank you so much for explaining it all on Unchained.
Thank you, Laura.
Don't forget, next up is the weekly news recap, today presented by Wondercraft AI. Stick around for This Week in Crypto after this short break. Polkadot is the original and largest Layer 0 blockchain with over 2,000 plus developers. The anticipated Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem. upgrading the infrastructure with 8 times higher transaction throughput and twice as fast block times, tailored core time for the needs of every protocol, trustless bridges to multiple chains, and revised tokenomics with a token burn to reduce inflation. Perfect for GameFi and DeFi to build, grow, and scale. Get your Web3 ideas to market fast. Think big, build bigger with Polkadot. Join the community at polkadot.network/ecosystem/community. Did you know you can buy and sell crypto with tax benefits in an individual retirement account or IRA? iTrust Capital makes this possible. But what does this mean? When you buy crypto outside an IRA, like on an exchange, you face taxes on gains. But in a Roth IRA, gains would be tax-free. iTrust Capital also has the lowest fees in the industry and 24/7 accessibility. Start now and maximize your retirement savings with iTrust Capital.
Welcome to this week's Crypto Roundup. In today's recap, we dive into Donald Trump's latest crypto venture, World Liberty Financial, and its ties to Doe Finance. We also explore the heated debate between Solana and Ethereum communities over network extensions, and the SEC's warning to FTX about repaying creditors with crypto. Plus, we'll cover the Federal Reserve's cease and desist order against United Texas Bank, Polygon's migration from Matic to Paul, and the challenges Bitcoin miners faced in August. Lastly, we discuss the WazirX hack and a surprising marketing stunt by Near Protocol. Thanks for tuning in to the weekly news recap. Let's begin. Trump-backed DeFi project allegedly based on Doe Finance code. Details have surfaced about Donald Trump's crypto project, World Liberty Financial, revealing that its foundation may be built on the code of DeFi protocol Doe Finance. According to a CoinDesk report, the project, which involves Trump's sons, Donald Jr., Eric, and Barron, centers around a credit account system on the Ethereum blockchain. The project, initially branded as the Defiant Ones, has been shrouded in secrecy since it was first announced in late August. However, a white paper and a since-deleted GitHub codebase indicate that the project closely mirrors Doe Finance, which suffered a $1.8 million hack in July. Despite these revelations, the team has yet to confirm if the final product will incorporate Doe's code. The project will also reportedly feature a non-transferable governance token called WLFI, adding another layer of intrigue. Critics have raised concerns about the project's transparency, given its connections to a previously hacked platform and the involvement of several controversial figures. In addition to the credit protocol, World Liberty Financial has expressed a strong interest in driving the mass adoption of stablecoins. The project team has emphasized their commitment to security, announcing partnerships with top security firms such as Zokio, Fuzzland, and PeckShield. According to a statement from the group, the project's code has undergone thorough reviews by these industry leaders to ensure user safety. The Trump-backed initiative aims to leverage stablecoins as a key component in its mission to revolutionize the DeFi space. Solana's network extensions stir debate among Ethereum supporters. A controversy has erupted between the Solana and Ethereum communities over Solana's introduction of network extensions, which some argue are essentially Layer 2 solutions by another name. Traditionally, Solana advocates have criticized Ethereum's modular approach of using Layer 2 networks to scale its blockchain. However, Solana is now embracing a similar concept, though it avoids the L2 label, calling these technologies network extensions instead. This shift has sparked debate, particularly among Ethereum proponents who argue that L2S are not parasitic, as some Solana supporters claim. Ethereum investor Ryan Berkmans emphasized that L2S complement the base layer rather than detract from it. Despite the rebranding, the core functionality of these network extensions seems similar to L2S, leading some in the community to see the distinction as mere semantics. Solana's co-founder Anatoly Yakovenko defended the term, arguing that network extensions serve unique purposes such as specialized processing, unlike Ethereum's general-purpose L2s. SEC warns FTX on repaying creditors with crypto. The U.S. Securities and Exchange Commission has issued a warning to FTX in a recent filing, signaling potential opposition to the bankrupt exchange's plan to repay creditors using stablecoins or other digital assets. The SEC also expressed concerns about a discharge provision that could limit the future legal liabilities of the FTX estate. During FTX's bankruptcy proceedings, various strategies have been considered to maximize creditor recovery, including proposals to restart the exchange or distribute claims as tradable tokens. Despite these discussions, FTX, under CEO John Ray III, has rejected the idea of relaunching the exchange, citing a lack of investor interest. Research firm Split Capital suggested this week on X that FTX might ultimately inject around $1.5 billion back into the crypto market. However, Split noted that this amount is significantly less than the $16 billion initially expected. Federal Reserve issues cease and desist order to crypto-friendly bank. The Federal Reserve has issued a cease and desist order against United Texas Bank, citing significant deficiencies in its management of risks related to crypto customers and foreign correspondent banking. An examination in May 2023 revealed shortcomings in the bank's governance, particularly in its anti-money laundering compliance and oversight by its board and senior management. The Dallas-based bank, which has ties to the crypto industry, has agreed to the order and is now required to file a detailed action plan within 90 days to strengthen its AML programs. 21 Shares enters Ethereum's wrapped Bitcoin market. 21Co, the parent company of 21 Shares, has introduced a new wrapped Bitcoin token, 21BTC, on the Ethereum blockchain. This move follows the earlier launch of 21BTC on Solana, aiming to provide a secure alternative to existing options such as wrapped Bitcoin. The launch comes as WBTC faces declining trust due to changes in its custodial arrangements. 21Co says that 21BTC is designed with enhanced security measures and backed by institutional-grade custodians, positioning it as a more reliable option in the wrapped Bitcoin market. Polygon begins migration from Matic to Pol. Polygon has started its planned migration from the Matic token to the new Pol token as part of its Polygon 2.0 inches roadmap. The upgrade, which began on Wednesday, marks a significant shift in Polygon's tokenomics, introducing an annual inflation rate of 2%. The new POL token will replace Matic as the native gas and staking token on the Polygon POS chain and will play a central role in upcoming features such as the AG layer and the Polygon staking hub, set to launch in 2025. According to Polygon Labs CEO Mark Uyeda, the migration allows for greater flexibility and community involvement in the network's growth and sustainability. Bitcoin miners face toughest month since 2023. Bitcoin miners experienced their worst month in a year, with August 2024 revenue dropping to $851 million, a 10% decrease from July. This marks a 57.5% decline since March, when miner revenue peaked at $2 billion when Bitcoin reached all-time price highs. The recent downturn has been attributed to the post-halving landscape, which reduced block rewards by 50%, severely impacting profitability. Despite a record-high hash rate of 782.6 exahashes per second in August, miners are struggling as transaction fees have also plummeted by nearly 45% since September 2023. WazirX users face significant losses after $234 million hack. Users of the Indian crypto exchange WazirX are expected to lose over 40% of their funds following a $234 million hack in July, per a TechCrunch report. The exchange, now undergoing a restructuring process in Singapore, has informed users that they may only recover between 55% and 57% of their assets. The hacker, believed to be associated with North Korea's Lazarus Group, has started moving nearly $4 million in stolen Ether using Tornado Cash to obscure the transaction trail. WazirX has requested breathing space from Singapore's High Court to develop the fastest and most effective method for users to reclaim their remaining funds, which will be distributed on a pro rata basis. Time for fun bits. Near Protocol's X account hack turns out to be a marketing stunt. On Wednesday, Near Protocol's X account appeared to be hacked, with the hacker posting a series of messages criticizing the crypto ecosystem. The incident caused a stir, as many believed the account had genuinely been compromised. However, it was later revealed that this so-called hack was actually a marketing gimmick by Near Protocol to promote their upcoming hackathon. The account was even renamed Scam as part of the stunt. While some found the move clever, others weren't so impressed, calling it a cringe fest on crypto Twitter. Love it or hate it, the hackathon is now definitely on everyone's radar. And that's all. Thanks so much for joining us today. If you enjoyed this recap, go to unchainedcrypto.substack.com, that is unchainedcrypto.substack.com, and sign up for our free newsletter so that you can stay up to date with the latest in crypto. Unchained is produced by Laura Shin with help from Matt Pilchard, Juan Aranovich, Megan Gavis, Pam Majumdar, and Margaret Correa. The weekly recap was written by Juan Aranovich and edited by Nelson Wang. Thanks for listening.
Unchained is now a part of the CoinDesk Podcast Network. For the latest in digital assets, check out Markets Daily, 5 days a week, with host Noel Atchison. Follow the CoinDesk Podcast Network for some of the best shows in crypto.